everyone, and thank you so much for joining us for today's Cherry Bekaert webinar. My name is Madeline Robbins, and I'm our production manager here at Cherry Bekaert. Today's 1-hour session will cover how financial services and fintech companies can take advantage of R&D credits and tax savings, along with understanding the federal and state R&D tax credit requirements. We will also cover the proposed changes of Form 6765, with the importance of documentation and so much more. Before we get started, here's some quick items to note. To receive CPE credit, you must answer at least 3 of the 4 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. If you have not received yours after 10 days, please email us at cbhlearning@cbh.com. A recorded version of the webinar will also be available in about a week and will be sent via email and posted to our website. Now, if you have any questions during the webinar, type those into the Q&A window that's located down in your control panel. And just note, we will be sharing a short survey at the conclusion of the webinar. We value your feedback and ask that you take part. With that, I would like to introduce Marty Karaman, leader of Cherry Bekaert's Tax Credits and Incentives Advisory Group. We also have Vivian Kors today speaking, Strategic Tax Director in Cherry Bekaert's Tax Credits and Incentives Advisory Group. Please, Marty, take it away.
Thank you very much, Maddie, and welcome everyone. Really happy that we got a nice turnout for this today. Yeah, so the overall discussion on whether you qualify for the R&D tax credit is actually going to be, we're going to cover a little bit of a broader topic, whether you do or do not qualify for the R&D tax credit, although I think many of the participants will. The issue that we're going to address is how the rules around R&D affect you, irrespective as well of whether you're claiming a credit. So we're going to go into a bit around some of the changes that came into place in 2022, specific to the deductibility of research and experimentation expenses and software development expenses under what's known as Code Section 174. We will then talk a bit about the actual bread and butter of what we do quite a bit of is the R&D tax credit type work, the expenses that go into that, and some activities that so you can understand specific to this industry where we focus. Beyond that, we're going to talk a bit about what are the qualified expenses, how you calculate the credit. We'll go through the state credits, proposed changes, as Maddie alluded to. So why don't we move to the next slide? All right, so we have a polling question. Number 1, how did you hear about this webinar? Was it a Cherry Bekaert tax advisor, an email from Cherry Bekaert, a friend or colleague, or a Cherry Bekaert alum, or there's 5 here, or a social media post? There's no wrong answers. So hope everybody takes some time to fill this out. And again, however you heard about this, we're very happy that you're here. Financial services is something that Vivian and I specifically have wanted to cover for a while for this group. She and I both spent a lot of our careers in New York. Specifically, I worked quite a bit with respect to fintech, banks, and exchanges. And so I've seen it from many sides with respect to financial service. When we think about financial service stuff, it's generally software development type work, and that can vary, but we'll get into what does and does not qualify. All right, with that said, great polling question 1. They got an email from Cherry Bekaert. So special thanks to Lindsay and Maddie on here for sending out emails. Okay, so now we're going to talk about Section 174. And we can go to the next slide a bit. When we think about, we'll go down deeper for a second. When we think about the research credit Section 41 can best be thought of as a subset of 174. 174 type activities are those that are experimental and with some technical uncertainty associated with them. Generally speaking, and historically, up until 2022, you had some flexibility in terms of how you treated them. They were either currently deductible, or you had some options to capitalize and amortize them over certain periods of time at your election. That is now gone. So as was passed in 2017 and came into law in 2022, the expenses specific to what we call 174, research and experimentation expenses, are no longer currently deductible. They are now required to be capitalized and amortized over a period of either 5 or 15 years, depending on whether they are US-based or foreign activities. And so again, Section 174 and we'll get into some of the differentiation on 174 and the research credit, but 174 costs include all costs, incident to the development or improvement of a product. And examples are your QREs, as you would ever go, your qualified research expenses that go into the credit calculation, patent costs, overhead, G&A support, some foreign R&D costs, which are not included in the research credit, and potentially depreciation as well. And when we talk about what goes in the research credit, there's actually some add backs additional on top of what we have as typical qualified research expenses. So this is a big deal for a lot of companies, because whether they're claiming a research credit or not, when you can't deduct a large number of costs associated with people, just the wage expenses that you normally would under what we call 162, by definition, your taxable income will go up. And so that means that the credit itself will be more valuable on a, we'll call it gross basis, but net across the board, many companies are going to have increasing tax liabilities as a result of these rules. And so it's going to be very important not to focus just on the research credit, but what expenses are 174 specific. And we're working with a lot of companies right now on not even research credit studies, but just 174 analyses. We're beginning to do more of those, which we've done historically, but it's going to be almost mandatory now for every company to look at this. We can move on. All right. So, we talked about amortization, capitalization and amortization of costs. The 174 costs are for those incurred in the US, capitalize and amortize them over a 5-year period. And it's a mid-year convention. So that means in the first year, you will really only be getting about 1/10 of what you would normally get as a current deduction. 15 years for foreign. So that's going to be, there's a lot of companies that use foreign developers to develop software on their behalf. That is most likely going to be considered a 174 cost. We can analyze that with our clients, but it's something to keep on your radar, because instead of getting a current deduction for this offshore software development that's probably cheaper than doing in the US, now you might not get that current deduction for it. So it's something to think about as we go forward. We can keep going. So it is a method change, this change from the current deductibility to the capitalization and amortization. And everybody had been waiting for the IRS to provide guidance on this. And the reason they were waiting is because the IRS was waiting. It was commonly thought and probably well agreed that this change to the law would be retroactively repealed and either pushed off into the future or just completely eliminated. It really was a revenue generating provision that came out of the Tax Cuts and Jobs Act that was passed in 2017. So what tax reform gave in terms of rate decreases beginning in 2018, this was intended, at least from a budgetary perspective, back in 2017 as it was passed, to pay for some of those rate cuts, with the somewhat expectation on Congress that they would actually push it down the road a bit. It didn't happen. For a variety of reasons. It was included in some of the Build Back Better legislation and had always been treated as an item that had the support of, we'll call it both parties, both chambers, the executive branch as well, but in the negotiations, it fell out. And so when we ultimately got to the omnibus package that was passed at the very end of 2022, it didn't happen. And so it maintains and stays in the law. And so it continues that these 174 type research and experimentation expenses are not currently deductible. We don't know what will happen in the future, but we certainly cannot count on this being repealed. And so it's something we have to pay attention to. It's something that companies have to take into account with respect to their 2022 provisions. And so that's why we're talking today. This is probably on everyone's mind, probably even more than the research credit, but I think the research credit is at least the sweetener on top of this, in the sense that it is at least a dollar for dollar reduction of your tax liability to the extent you identify a credit, becomes more valuable when you have a higher tax liability. So let's continue on. Yeah, the method change, I didn't actually cover this because I was talking, but this is a method change, and there was a guidance put into place. For the most part, what the guidance says is that you don't have to file a 3115 to the extent your next return is being filed. Really, you just have to file a statement identifying the name of the taxpayer, the beginning and end dates of the first tax year of change. That is an automatic method change. A description of the R&E expenses, and a description of the R&E expenses paid or incurred in the first year. There was also a declaration that's required to be made that you're changing your method of accounting to capitalize and amortize. And it's what it says is it's done on a cutoff basis. And what that really means is that you don't have to make any changes to the current deductibility that you had in prior years. It's beginning in this first year. For the most part, if you're on a calendar year, that's calendar year 2022. And so it's that year that you begin to identify and quantify 174 for this purpose, and it begins anew without having to make adjustments to what happened in prior years. There's some specific other rules for companies that have short taxable years or that missed a year with respect to these method changes. We can move on to the next one as well. All right, I'm already at the second polling question, so everybody is getting very close to CPE here. With that said, is your company currently identifying and quantifying its Section 174 costs? Yes, no, or not sure. And again, no wrong answer. This is really just a matter of what you have been doing, and many companies had not been, because 174 was most treated as currently deductible, not particularly different than 162. It didn't make a difference. And so it is something that we are focused on with our clients. I'll be quiet for a moment as we wait for the results to come in. Aha, half and half. Oh, no, third. That's amazing. So great to 33% of you. And for the rest, we should talk after this. Always happy to help on this. So we're going to get now into a subset of 174. It's really costs less than it is activities. But we'll talk a bit about the research credit, and Vivian's going to cover most of this. But when we talk about the research tax credit, it dates back to 1981. It really is an incentive to promote innovation. It's a permanent item, meaning that it used to be something that had to be renewed by Congress every 2 years or a year and a half or 3 years, depending on what was going on with respect to the legislation. And that was a waiting game we used to play every year to see if Congress would pass it, if they let the date pass. And we were thinking the same thing would happen with 174 this time. With that said, again, federal tax credit designed to promote innovation, designed to promote, promote the hiring of people of scientific or technical or engineering backgrounds or software development backgrounds who are addressing what we'll call technical uncertainties. You receive these tax credits for expenses incurred for increasing R&D activities, which just means that the credit itself is incremental. In order to identify what your current qualified research expenditures that are actually credit eligible, you need to measure what you did in the past. So it does have a measurement of what you did in the past compared to today. It's important to note it's a dollar for dollar reduction of your tax liability. It's not a deduction, but rather a credit. And again, the cost supporting the credit, again, may not be deducted from taxable income. That's the 174 stuff. So let's move on to the next. All right. From the perspective of this slide, we're just focused on the fact that from a process perspective, if you're looking at your Section 41 research credit, it's important to look as well at 174. They really do go hand in hand. And if you've had a research credit done in the past, you're probably going to have some sort of increase in scope to that analysis for 2022. If you didn't have a research credit in the past, you're definitely going to have an increase in scope to take a look at 174 R&E and bucket your costs a bit to understand what is currently deductible and what is amortizable. Again, R&D for this credit is so much broader than what you think of as, or what many would think of as, traditional like white lab coat R&D. R&D is really activities performed, as I like to say, by smart people in the US, tackling difficult or technically uncertain issues. It comes down to areas within the software development lifecycle where there is technical challenge that you're addressing. And then beyond that, when you get to the production support, maybe some of that ends. One other thing we're going to talk about as well, and we can get into, is that generally speaking, the research credit required a reduction from your current deduction to the amount of your credit, because there's no more current deductions. That's no longer required in most cases. And so what we used to have, we would calculate as a net credit by operation of a provision called 280C. You actually get your full gross credit now, and we can get into some of those rules in a bit. But generally speaking, compared to the way you calculated it in prior years, you'll actually get a little bit of a higher credit than you did, because it'll be the gross credit at the statutory rate. And this is a bit of just background in terms of like how many companies actually claim the research credit. You know, it says only 35% of taxpayers eligible to claim it do. I generally find that's true for a number of reasons. Sometimes they think they can't monetize it, meaning it's not something that they can currently use in a refundable way to get a check back. It's rather just a reduction of your tax liability. If you don't have a tax liability, then often companies will not take advantage of that. But there are some special rules for startup companies as well. Vivian, why don't you continue on?
No, absolutely. So R&D tax credit, overall, it's great. As Marty mentioned, there's for startup companies, there are certain rules where your gross revenues can't be above 5 million in the current tax year. You can't have gross receipts before the 5-year period. Then you could potentially use your R&D tax credits up to $250,000 to offset your payroll tax liability. Now, starting 2023, that actually goes up to 500, which is very exciting. And then similarly, on top of the federal benefit, 36 states as of right now offer a similar tax credit to reduce your state tax liability, or that you, like, for example, in Georgia, you can offset your Georgia payroll tax withholdings. So there's a lot of great benefit in addition to federal tax, federal R&D tax credits. Now, the fun part is, in addition to just looking at your current tax year, to the extent that you have any open tax years, that's also something that's in play, so to speak. So if this is something that you haven't previously looked at and you know that you had R&D in the past, it would make sense to kind of lump all of the analysis into a single year, and we can address any of the changes. If it's worthwhile to amend your returns, then let's amend your returns to make sure that you can capture that benefit going forward. Now to the fun part, right? We've all heard how great R&D tax credits are. How do you qualify? What makes a company qualify for R&D tax credits? So there is generally what we call a 4-part test. Now, this is an activities type evaluation, and your activities must meet all 4 parts of these tests in order for the dollars associated with those activities to qualify for the R&D tax credit. Now, the first test, permitted purpose test, what this is saying is at the outset of the project, your project or your initiative, you're trying to improve or develop new functionality, performance, reliability, and or quality of the product. So functionality is previously our system couldn't do X, Y, and Z. Now it reports, now it can generate these reports automatically. Performance is previously it took us, X hours to run these reports. Now it takes us, it's a near real-time report that we can run, on the fly. And that really supports business in XYZ way. So that would be a performance improvement. Reliability, cybersecurity, those are things that are extremely relevant nowadays. Maybe it's system availability. It reduces your downtime, system downtime down to, X versus Y. And then quality, maybe it's improving your overall scalability. Maybe it's improving your overall data quality or your accuracy in that regard. So that would all meet the permitted purpose test. Now, technological in nature. This is really saying that the activities must rely upon a hard science versus your fun social sciences or marketing, anything along those lines. So we're looking for, in a lot of the financial services companies, fintech companies, that's all in the computer science arena. So this is the easiest test out of the all 4 tests to be met. Then we have the 3rd and 4th test, and these 2 tests I would say would be the most gray and where we would generally spend the most of our time doing the analysis. So the 3rd test, elimination of uncertainty, and this goes hand in hand with the process experimentation test, because elimination of uncertainty is saying at the outset of the project, there has to be technical uncertainty as it relates to the capability, method, and or design of the product. So capability is, oh, this is such a novel idea. We didn't even know we could get the system to do X, Y, and Z. Method is we knew we could eventually get there, but we weren't sure what the optimal way was to go about development to either minimize downstream impact or, to improve to shorten the development timeline. And then design, we weren't sure what the optimal design of the system was in order for it to be most performant. Then through a process of experimentation, you guys looked at one and more alternatives to try to resolve the uncertainty. You didn't have to have succeeded in resolving the uncertainty, but you have to have tried. And this is where we want to gather examples of, hey, first we tried Y, that didn't work. Then we tried Z and that didn't work, but the combination of Y and Z worked because of ABC. So that in a nutshell is kind of an activities test of meeting all 4 parts in order to qualify for the R&D tax credit. Now, for internal use software, and this is, I know back in the day, this was one of the most contentious area that people were always arguing about. But now that there's clear guidance, this is affecting less and less taxpayers because of the applicability of internal use software. So internal use software is essentially, to the extent that this is a system or software that only is being used by the taxpayer for G&A function. So if you guys have, for example, an application for online banking, right? But because third-party vendors, your customers or third-party vendors access that software, that's not internal use software. Internal use software would be, for example, you guys use Hyperion for reporting, and you guys need to customize Hyperion for your specific use. That would be internal use software and would need to meet these additional 3 tests. So the significant economic risk, this is saying, hey, it wasn't a simple undertaking for you guys to do that. Innovation test. This means that the measurement of the improvements in either reduction in processing speed, reduction in operational cost, has to be a measurable improvement. So previously, it took us to run this Hyperion report. It took over an hour. Now it takes under a minute to run that. That would satisfy that innovation test. Now, commercial unavailability. What this is saying is this can't be something that's off the shelf. It can't be a COTS. It needs to be something that required significant modification or customizations in order for it to be used in your context or to be used for your business or your operations. So those would be the additional 3 tests that the taxpayers would need to meet for internal use software. Now, specifically, the types of activities, because Marty and I have specialized in financial services companies, given our location, we look at some of the activities, and sorry, we can go to the next slide, that have previously qualified for our fintech companies. So to the extent you guys are developing, you guys have your own in-house banking trading platform, to the extent that there's additional security protocols that you guys are trying to enhance, improve, maybe it would be login security, maybe it's data security, anything around the blockchain, cryptocurrency innovations. We're seeing a lot of these right now. To the extent that there's any AI that you guys are developing, those would all be things that's potentially qualifying. Any risk management reporting, any changes to reporting due to regulatory changes, anything that you guys would need to generate reports that previously you weren't required to, so it required a lot of data integration, maybe required you guys to build APIs into other people's systems and needed you guys to build API into your disparate systems to bring them together so that you could improve upon your systems. Those would all be potentially qualifying activities. Mobile banking technologies, any enhancements to off-the-shelf software. So this is kind of what we're talking about. The configuration of off-the-shelf software wouldn't qualify, but to the extent any customizations on top of that, any enhancements on top of that, those would all be potentially qualifying. Marty, anything that you see in your industries?
Well, I would say this, let's take it from the other perspective. I tend to always get the question, well, we did a large ERP implementation, what about that? That's definitely on the other side of the scale of what we're talking about here. That is a tough fact pattern to qualify for the research credit these days. That does tend to fall in the purchasing of modules that are then configured, predefined, understood how they're going to work and work together. And by the way, that type of activity is really where you want to look at 174, because a lot of that might not even be 174. eligible. And so that's the kind of expense that I don't want you to overthink. Maybe you have to capitalize all of that for tax purposes. It's the opposite. It's the non-R&D study where we take a look at what might not be 174 if we can identify certain buckets of costs there. A lot of it's different systems talking to each other as well across the board. That's an area where we can see, you have legacy system, new things coming in. I think the most important thing here that I saw that Vivian talked about was it's the enhancements to off-the-shelf software. Very little, not as much as we think is just developed completely in-house. Most things begin with something that's purchased, and it's the enhancements to address not defects or bugs, but rather deficiencies in the software, meaning the software doesn't meet the needs of your particular environment. And so that's how we need to think about it. Yes, the purchase of what you did from a basic level is not qualifying, but all the software development on top of that can be. And so again, these are great examples. We've seen many of them. We've even seen it's not quite financial services, but in NFTs as well. There's been some work we've done around that too.
Your company is growing and your technology is trying to grow with you, that's something that you should look at. So like if it's scalability of your systems, because now you have to support X customers that you previously didn't, there's potentially areas of development that we should look at there. Or maybe you guys were previously a monolithic type development company, or your architecture is monolithic and you're going into more of a modular type so that it could improve your scalability. Those are all things that on a bigger scale that we can look at.
One last thing, and this is why I love financial service companies and software development in general. So many of them, after their startup phase, tend to use and track their time in some kind of regimented time tracking system. That's a wonderful way to begin the analysis, to understand what the projects are every year. And oftentimes it's at least tracked to development, production, and support type activities, or they may be called something else, but that's something that we will often rely on as we look at this and sort of carve it down and slice it up a little bit. So, and if you don't have time tracking, that's fine. The credit does not necessitate a time tracking system, but ultimately when we do these analyses, we do roll our costs up to certain initiatives, what the code, or at least the IRS will refer to as business components. And so that's just something else to keep in mind as well. But I certainly love the software and financial services area because they tend to have an organized approach, identifying what their software development, what the activities are within the software development lifecycle, and then we associate that with these type of different initiatives. All right, let's keep going.
And then we get to the fun. Well, so what's not qualifying, right? Because we talked a lot about qualifying. So this is your maintenance, keep the lights on, support, any bug fixes that didn't arise to the level of starting a brand new initiative to fix the problem, didn't rise to the level of technical uncertainty, those wouldn't qualify. Some of the other things that are listed here, I do want to call out your configurations, your like, hey, the data couldn't quite look right, so we couldn't ingest it correctly, so we had to manually go fix it. Yes, it's time consuming. Yes, it's annoying. Yes, it's challenging, but that's not technically challenging. And that's where I want to differentiate. Where we also have listed here, funded research and foreign research, although that is not qualifying for R&D tax credit purposes, it is a 174 cost, and it is something that we do want to talk about. I know in the Q&A section, someone asked a question about funded R&D grants. Those are now in play for 174. They're still not in play for R&D tax credits, but for 174, that's something that's going to impact your taxable income. Foreign research, that's where Marty said your 174 your foreign 174 is now capitalized, amortized over 15 years. Still unfortunate part of your R&D tax credit, but still something that you need to be evaluating and looking at as part of your tax return. And now we have polling question 3. Does your company, based on your understanding of what qualifies versus not qualifying in terms of R&D, does your company conduct potentially qualifying R&D activities? Yes, no, maybe so.
From a credit perspective, I guess, not from a 174 perspective.
Correct, from a credit perspective, because that's what we were talking about in terms of the 4-part test and then the additional 3-part test for IUS. And IUS is short for internal use software.
And I just realized I've forgotten to do the polling question, so I'm not getting CPE today.
I think you have more than enough, Marty.
Thank you.
Oh, and I had accidentally closed
I
that.
haven't. And
Oh.
the answer here is yes for 36% and no for 47% and 17 not sure. So that's great. You know, basically at least half, 36 or 17, something like that. We'll see has some potentially qualifying R&D type activity.
Yeah. So I know we're talking a lot about, hey, what do I need to do to be qualifying? Now we get to the fun part of what costs make up your R&D tax credit. So we're going to continuously refer back to what we call QREs. QREs are essentially your qualifying research expenditures. So activities that meet the 4-part test or the 7-part test, the costs associated with those R&Ds, these 4 buckets of costs would be part of your R&D tax credit. The bulk of, at least for fintech companies, your financial services company, the bulk of this would be in the buckets of your W-2 wages as well as your contract research expenses. So your W-2 box 1 wages is very important because you could only the box 1 W-2 wages could be considered part of your QREs. So don't start from gross wages, don't include benefits. However, for 174, gross wages, benefits, insurance, all that good stuff is all part of 174. How we capture W-2 box 1 wages, we can dive into that a little bit later on as we talk about our process. It will be either around using time tracking data to substantiate like the qualifying hours over their total working hours, or it would be a survey approach of, hey, John Doe, how much of your time roughly in 2022 was spent on these types of activities on this particular business component. In the fintech, in the financial services companies world, there's not going to be much supply costs because supply R&D costs are tangible products that are consumed as part of the research process. So if you think about like syringes used in your, medical device development, those are the supply costs that is meant to be captured here. Then we have cloud computing costs. So to the extent you guys are using Azure, AWS, Google Cloud, Rackspace, any of that good jazz, to the extent that a portion of that is related to standing up dev or sandbox or testing environments versus your production environments, the portion that's non-production, i.e. the portion that would meet the 4-part test, that would be the cost that would go into the bucket of cloud computing, computer rental costs. We have seen certain companies, and I want to say I've only seen a handful of companies where they're still renting laptops and renting computers. To the extent that you guys are doing that, renting your computers, the computer rental costs would qualify if they're doing development. And then the last tranche of costs, your contract research costs. So to the extent you're hiring unrelated parties to help you with your development activities, either more of a staff aug, capacities, like say, for example, we just don't have enough developers, so we're going to hire people on a time and materials basis. Those would be potentially qualifying contract research expenses as part of your R&D tax credits. We talked a little bit about how we determine qualifying wages, right? So to the extent the activities meet the 4-part test, they're directly performing R&D. However, the statutes do allow for 1 level up, 1 level down. So to the extent that you have someone in a managerial role who isn't necessarily doing the coding, but they're supervising, reviewing some of the codes, they're reviewing some of the designs, they're making some of the design comments, those would all be potentially qualifying wages. To the extent that you have people who are directly supporting your R&D efforts. So maybe it's someone in the finance department who's maybe doing any user acceptance testing for this new IT system that is doing a report that they need. That would all be potentially qualifying direct support time. To the extent that you have maybe product managers who's going out in the field to gather requirements, to the extent that they're technical enough and they're providing technical design inputs into what is being coded, then that time is also potentially qualifying direct support time. And then the last 3 tranches, we kind of talked about this in more detail, but I do want to point out that the contract research costs is only for onshore, meaning people physically located in the US doing the work. It doesn't matter if it's a US company, but they're hiring maybe someone in India to do the work for you. that wouldn't qualify. The resources need to be physically boots on the ground doing this. There is a 35% haircut that you would have to take for contract research expenses. And then to the extent you're engaging like research consortia, that would be a 25% haircut as opposed to a 35% haircut. And with that, Marty, I'll turn it back to you on how we actually calculate research tax credits.
Cool. Thank you. Let's move on to the next slide. All right, good stuff. So when we're thinking about the identification of qualified research expenses remains consistent, regardless of which method you use to calculate your credit. But after you've done that, as mentioned, I think earlier, this is an incremental credit. So it's a credit for increasing research activities. And actually, if your research activity or expenses are the same every year, you will still qualify for a credit, but you get a bonus, honestly, and sort of a pop on the rate of expenses that you have that will ultimately be credit eligible. What's known as the traditional credit can be utilized every year by companies, and what's also known as the alternative simplified credit can be utilized every year by companies. You can jump method to method if you make a sort of affirmative election year over year to do that. The traditional credit, it's called that because it was the first, not exactly the first credit, but at least back to like 1991, the way that you calculate this. Essentially, you look at your spending in a prior year that's qualified compared to what your overall gross receipts or sales are, and you come up with a percentage and you multiply that percentage by your average gross receipts from the prior 4 years. It's complicated because they never really updated the original base year rules that you need to look at. And so for companies that have been around a long time, you actually are supposed to look back and need to look at your spending in 84 through 88 time period. I doubt anybody on this call has that information or may not have even been around during that period of time. And if you were, you're probably taking a research credit anyway. In 2007, they simplified the rule, and that's in the name. They came up with a different method of calculating the credit to only require you to look at your qualified spend year over year, and then take 50% of the average of your qualified spend in the prior 3 years. And then that is your what's known as base amount. To the extent your qualified research expenses in a current year exceed the average qualified spend in the prior 3 years, multiplied by 50%, then you have this alternative simplified credit. Most companies have moved to this. However, most startup companies utilize the traditional credit because that's a more beneficial way to calculate the credit from a rate perspective for startup companies. And these startup companies generally do look at this early because, as Vivian mentioned, in the first 5 years, potentially, of a company's life, when it has qualified research expenses, it can utilize that credit beginning in 23, up to $500,000 of credit against payroll tax liability, $250,000 in 22, and years before that. That's something you have to analyze though early. You have to do that on a currently filed return. You can't go back and amend to get the payroll tax refund because it really is intended to incentivize companies to perform that research, calculate the credit, and take that payroll tax benefit so they can make the cost of employing people cheaper and hire more people in the US. That's the theory anyway. Our process really has been the same at every firm at which I've been, which is just 2, but it's essentially having conversations with the tax department, having some conversations with the developers or somebody at a higher level with respect to what the overall projects are, and then getting as much data as we can to assess what the potential range of benefit might be for a company. And here we do all of that on a for free basis. Essentially, it's a complimentary basis to take a look and get to know what a client's activities and costs are, so that we can intelligently come back to them with a work plan that then may require additional financial data, potentially at a more granular level. We will then organize and figure out what a project list is in a year, or look at the time tracking data and organize all the different projects into higher level initiatives. And then potentially have some interviews or discussions with the company about what the true technical uncertainties were on a year by year basis. And we can also go back a number of years, at least 3 years, potentially more, depending on what the corporate form, or not corporate, but whether it's a partnership, S Corp, LLC, there's some more additional flexibility with C corporations to go back and pick up additional years. as compared to some of the S corps or the partnerships. But nevertheless, we can at least go back 3 years. And at the end, we really pretend that the IRS will look at this. You're not required to file anything, at least not right now, with your what's called a Form 6765, where you report your research credit. You just report the credit and what the calculation is, and identify what your qualified research expense is. It's then, generally speaking, upon the IRS, to the extent they wanted to question it or look at it, or you might be under examination, to ask those questions. Now, we know what those questions are because they really haven't changed in the last 20 years. In fact, they've just maybe changed a few words in them. It really hasn't changed much, but they really want to know, well, getting back to our process, what they want to know is something that we address in our deliverable. It is a true audit-ready deliverable because we've seen every IDR issued throughout the country, probably from different areas, of the IRS, asking, who were the people on this? What were the projects? What were the technical uncertainties? Asking questions around, are you a controlled group of companies as well? Just getting a sense of like whether this calculation is yours or needs to be shared with other companies. It's well known what the IRS is looking at, and because of that, it's something that we address in our deliverables up front, so that to the extent, and where we do the IRS defense as well, and we're happy to do it because we know what the questions will be, so we're prepared for it. If we're doing our job correctly, it won't be any issue because we're really doing all that work up front. Why don't we move on? So in terms of data requests, these haven't changed in years as well. We're really looking at the W-2 wage data by person with a corresponding job title and department, the state wage, but now we're going to do the gross wage too, because that gross wage goes into the 174 calculation, as opposed to just the box one taxable wage, which goes into the credit calculation. So we're increasing what our I guess I'm wrong. We are actually changing our data requests because this is the first year we're going to have to look at some other things. Time tracking data, clearly most important. Even when vendors track into that time, that's great. And then just the general ledger, so we can understand, and here's the data that we have. We love data. The more data, the better. Companies are often afraid to say it's going to be too much. It never is, honestly. The more we have, the better we can get an assessment of what the landscape is of the entire company. And most importantly, from a credit perspective, identify all the costs that don't go into the credit so we can defend that and show the IRS we really are being specific in what we are including. It's really nice to carve out that negative space of what's not going in there, but also getting a holistic view of the company is going to be important from a 174 perspective. So we can look at what's not just credit eligible, but what may be research and experimentation beyond just the credit itself. Let's go to the next. This is important too. For those companies that don't have time tracking, our best method and practice is to issue a survey, which will really be issued through a piece of technology we've developed as well, to make it easy on sort of a web-based platform, to allow our subject matter experts at a company to identify which individuals are associated with which products and what activities they performed. It's a lot to do, but we try to make it easy. We will sit with people to do that. The larger the population gets, the more our technology tool is helpful in getting that out to a larger population of people. Sometimes it's a discrete number of individuals at a company. Sometimes it's a large population, and we'll tailor our methodology that way. But ultimately, the goal really is to get cost by activity, both qualified and non-qualified, and by project. In the end, it's kind of simple. You have a person, they spend amount of time on R&D and non-R&D. That R&D time is a percentage of time. That's the amount that is the qualified research expense for that person, but you got to carve into that for purposes of IRS defense in terms of what they were actually doing. And so that's been where we've been spending our time for years, just making sure we get that granular detail so that we can describe that well and understand the organization well, but really provide it for IRS defense purposes. I think I talked about this a bit, but here are some of the questions. All right. So, and this can be takeaway, but they want to know which departments, right, are performing R&D. Who are the people performing the R&D? Who had decision-making authority? Who got funding? these are questions that they ask a lot. They don't tend to ask it much exactly on exam, but they really do want to understand who the people are in the departments, and they really want to understand what the job titles are of the people as well, because you can include wages paid to people performing R&D, wages paid to individuals supporting R&D, potentially from a testing perspective, and wages paid to individuals directly managing the R&D. So an understanding of what the hierarchy is at a company is important. The list of the subject matter experts at the company, really the developers, and who is overseeing it, and who has a good understanding of what the technical uncertainties were. Are you in a control group with other key? Are you more than 50% controlled owned by 5 or fewer individuals? So you have to aggregate your expenses with another business for purposes of this research credit. Business components, it's a buzzword for R&D. Think of it really as what the initiative or the project is. The IRS just is mostly concerned with getting a pseudo project accounting system so they can understand. Your time tracking system does a great job of helping us do that. Otherwise, your project lists do a great job as well of helping us understand what the business components or projects are for a year. And of course, they want the credit calculation. I think there might be another slide after this. Yeah, so that's kind of the cost stuff. We talked about CD as a buzzword for contemporaneous documentation. Really just means like what was maintained during that period of time that can correspond to to sort of back up the story you're saying about what the technical uncertainties were in a particular year. We have an overall methodology memo. Again, this question about cost center methodology is meant to kind of make taxpayers put stuff on a project level or a business component level. And again, they want to make sure you're using the job titles. They want to know that you're using box 1 W-2 wages, etc. So let's move on. Okay, I think it's back to Vivian.
Yes, it is. So a lot of the fun stuff we're talking about, we're all around federal tax credits. We mentioned in the beginning that there are additional states that offer state benefits, and I have highlighted in each of the following slides some of the more unique states, because a lot of the states do follow federal format, but a lot of states also don't. California is definitely one of the states that do not follow, and sorry, we can go to the next slide. California is definitely one of the states that don't follow federal research tax credits. So one of the key differences is that there's two ways of calculating the California credit, and both ways require California gross receipts. The California gross receipts definition, at least for a lot of the software, so it needs to be a tangible sale. A lot of the financial services company, a lot of the fintech companies aren't selling a tangible good. So your California gross receipts would actually be zero, meaning your California state R&D credit isn't necessarily base limited by your gross receipts, and you would have a bigger credit than someone who does sell tangible goods. So to the extent you have any developers located in California, definitely something to look into. Connecticut is also interesting in that it has 2 credits. And Connecticut is actually one of the only states that talk about 174 and including 174 as part of their R&D tax credit. So remember the concept of section 174 being the bigger pie, and then section 41 costs, which is your R&D, your federal R&D costs, being a slither of that pie. Connecticut includes section 174 costs. So that's why we wanted to make sure we call that out. Georgia is a great state that offers a lot of state incentives, right? We all know about the film tax credits. That's why every single Marvel movie that Marty loves is filmed in Georgia. But in addition, they offer a great research and tax credit benefit. One being, if you do not have Georgia state tax liability, then you actually can use it to offset your Georgia payroll tax withholdings. There is a form that you would have to file within 30 days of filing your Georgia tax returns. But once you file that form, you would get an approval, and you would that would actually make your research tax credits immediately monetizable. So to the extent you're thinking of holding off an R&D tax credit study because you feel like you're not going to have taxable income, at least in the federal sense, Georgia, if you have developers in Georgia, that's something that you should look into, because it could mean that it's more monetizable than you actually thought. Pennsylvania wanted to call that out because it is an application-based credit, but the credit can actually be sold to third parties. So if you feel like it's not something that's monetizable, it can be sold, so it is now monetizable. It's an application-based award of credits. So similar to Virginia, Maryland, some of the other application of Florida, it's a pool of money that gets allocated. Texas, I wanted to call this out because Texas actually doesn't quite recognize the development of internal use software. So that's just something to be aware of and make sure that you are talking to us or your provider about your Texas R&D credit to the extent that the credit is claimed for internal use software. I know a lot of my clients, if they're located in Texas and they file Texas credit, the Texas government loves to audit R&D tax credit. So that's been fun to deal with. And then last but not least, wanted to call out Virginia because they have two types of credit. They have the minor credit and they have the major credit. It really depends on your qualifying research expenditures. If it's more than $5 million, then it's a major R&D tax credit. You get a separate pool. And if it's the minor R&D tax credit, then you have a separate pool that's for basically smaller R&D credits. The minor R&D tax credit is refundable. So yay, money in the pocket. The major R&D tax credit is non-refundable, but can be carried forward for 10 years. With that said, wanted to bring up our fourth polling question. Do you know if your company would benefit from state R&D tax credits? Yes, no, not sure. I know we only highlighted maybe 10 states, but there are 36 states that offer the R&D tax credit. I know Utah has 3 tax credits, all unique. Awesome. 25% of you guys said that you would benefit from state R&D tax credits. 38% said no, 37% said not sure. So with that, wanted to bring up some additional nuances within the research tax credit arena. So, previously, when you say you found out, hey, in my prior 3 tax years, my statutes are open and I do qualify for the R&D tax credit, I would like to amend my returns. Previously, you would actually only just have to file your amended returns, and as part of that, file your 6765 to get those credits. Now, starting January 10th of 2022, which I know is like over a year ago, you actually have to file an additional statement that talks a lot about different disclosures and information that you would need to disclose in order to claim an R&D credit on an amended return. You'll kind of see, because we're going to talk about the proposed changes to Form 6765. This was the IRS's way of dipping their toes into changes of requiring more information to file a credit claim. So a lot of this is going to go back to those buzzwords. What are each of those business components that make up your R&D tax credit? What is the research activities being performed on each of those business components? And who's performing those? What information are they seeking to answer, right? That goes back to the technical uncertainty. What was their technical uncertainty? And what were they doing to try to resolve those technical uncertainties? And then we would have to also provide the total QREs, qualifying research expenses, broken down by employee wage, qualified supplies, and qualified contract research, and qualified cloud. That's easy. That's all in your 6765. But all of this information must be submitted when the refund claim is filed, or else the IRS is going to throw it out. And with that, we can turn back to Marty to kind of talk about the proposed changes to the Form 6765, which is very much in line with the additional disclosure requirements on refund claims.
Yeah, so we have like 7 minutes left, maybe just 2 in this thing, but I'll just say it's almost the exact same thing. What's happening here is both for the amended claim thing that Vivian just talked about was important because there were a lot of companies that perform research credit analyses that were putting in just a volume of R&D credit amended returns. And in order to process those, the IRS came back beginning last year and required that disclosure that Vivian talked about in order to just get it into the analysis for IRS to look at it. This is almost the same thing, and this is actually what happens in some foreign countries as well, is that the IRS has proposed, and this may not happen, and it may happen, we shall see, I find these things when they're proposed don't exactly happen the next year, but understanding exactly, again, what the business components are, whether the taxpayer is a member of a control group, the amount. This is interesting, the amount of wages coming from the compensation of officers, because one of the concerns is always like if you have people that are sort of like highly compensated and they're just touching the R&D a little bit, but that adds quite a bit to the R&D tax credit calculation. It's perfectly permissible if they are, but nevertheless, it seems to be an area with the IRS on which they want to focus what the acquisitions and dispositions were, because when you acquire or dispose of a company, its attributes specific to R&D in that base amount come or go with it. Highlight basically, again, the categories of R&D, and then, there is also some guidance from the service around ASC 730 audited research and experimentation expenses, which provides an alternate method of including certain expenses. And so you'll see these questions are a little bit different than the ones that are on the amended return disclosure, but it is interesting that both for amended and now potentially in the future for currently filed returns, it does seem like the IRS is focusing on getting more data up front. And I really think the reason is because they don't want people just putting in frivolous research credit claims. And that's fine with me, because that's always been our thought as well. We do a lot of work around this. It's important to us that we identify the right amount of expenses and tell the story the best way. And so, yes, that I believe is all we have. Is that correct today?
Polling question 5.
Very good. Polling question 5. Everybody got a shot. Okay. Would you like to learn more? Yes or no? Maybe in the future. The answer is yes, guys. I hope it doesn't all come back no.
I answered yes, so you'll get at least one yes, Marty.
Very good. And this is excellent, by the way, as this comes back. Yes, all right, good enough. 32% of you have been on board the whole way about your research credit applicability, the state stuff, and also whether you want to learn more. With that said, thank you, everyone, for participating today. Again, and Maddie, I don't know if there's anything that I'm supposed to read at the end here, because I don't have it in front of me if I do, but if I don't, I just want to thank everybody for their participation. We did it on time, and I certainly have enjoyed the opportunity to talk about financial service stuff with this group. Vivian and I are always available should you want to actually reach out to us at any point. I'm certainly always checking my email, as is Vivian. So we certainly see about that. And then I think that's all we have. Thank you, Maddie.